In January 2023, an investigative firm operating from a small office in New York caused a decline of over $100 billion in stock market value for a single global conglomerate in less than a week. The instrument utilized was a 90-page investigative report published online. This practice, known within capital markets as activist short selling, involves a calculated public disclosure designed to systematically reduce a target company's valuation. For the targeted entities, the publication typically results in an immediate erosion of market confidence, the freezing of institutional credit lines, and a rapid contraction of capital reserves. The methodology relies on asymmetric intervention, wherein a small group of forensic analysts uses primary data to challenge the valuations of large-scale corporations, uncovering reporting discrepancies or systemic governance, failures that traditional oversight bodies overlooked. The operational framework of activist short selling requires an understanding of the specific regulatory mechanisms embedded within modern international exchanges. Unlike traditional short selling, where an investor borrows shares, executes a sale at current market prices, and attempts to purchase them back at a lower cost, activist short sellers directly precipitate the market correction. Investment firms such as Hindenburg Research, founded by Nathan Anderson, and Muddy Waters Research, founded by Carson Block, identify corporations where public financial statements diverge significantly from underlying operational realities. Focus for these short-selling firms is a cross-border regulatory mechanism known as a reverse takeover or reverse merger. For a foreign enterprise to list its shares on a major Western stock exchange via a standard initial public offering, it must comply with extensive financial transparency requirements, regulatory audits, and multi-jurisdictional background checks. To bypass these administrative barriers, foreign entities frequently acquire a defunct shell corporation already registered and listed on a Western exchange. Through this merger, the operational business inherits the existing listing status, gaining immediate access to public retail and institutional capital markets without undergoing the rigorous vetting typically mandated by state market regulators. This structural framework has historically allowed entities with unverified financial metrics to establish positions on major indices, creating defined targets for activist short sellers, who analyze the physical infrastructure behind the reported numbers. The development of an activist short campaign involves prolonged, undercover investigative research and physical asset verification before any public declaration occurs. On June 2, 2011, Carson Block's Muddy Waters published a research brief alleging that Sino-Forest Corporation operated as a multi-billion-dollar fraudulent enterprise built on non-existent physical assets. At the time of publication, Sino-Forest was Canada's largest publicly traded forestry firm, maintaining a reported market capitalization exceeding $6 billion and claiming ownership of extensive timberlands managed through 60 regional offices across 9 provinces in mainland China. The corporate narrative provided to international institutional investors described a highly profitable, scalable timber acquisition model. Muddy Waters did not base its assessment on the audited financial data validated by the corporation's executives or its external accounting partners. The firm deployed 10 independent forensic investigators directly into remote areas of Yunnan province within mainland China for a continuous 2-month period. These personnel physically verified timber transport routes, conducted interviews with local logging operators, and cross-referenced satellite coordinates listed in the corporation's regulatory filings against physical topography. The field investigation established that the actual infrastructure did not support the reported inventory metrics. Carson Block later documented that transporting the volume of timber Sino-Forest claimed to harvest would have required the simultaneous operation of over 50,000 cargo trucks on narrow mountain roads, a scenario he described as mathematically unsustainable. The field team confirmed that the timber tracts claimed by the $6 billion enterprise either did not exist or were the legal property of local regional municipalities. Following the distribution of the Muddy Waters report on June 2, 2011, institutional investors liquidated their holdings, causing Sino-Forest's share price to drop 82% within several weeks. The sudden market correction affected major institutional capital blocks. Billionaire hedge fund manager John Paulson, who held a highly concentrated equity stake in the Forestry Corporation, was exposed to the rapid asset devaluation. His investment fund subsequently liquidated its entire position in Sino-Forest, recording a realized loss of $720 million in investor capital. On August 26, 2011, the Ontario Securities Commission intervened by issuing a formal temporary trading halt on all Sino-Forest securities due to pervasive disclosure and fraud concerns. Deprived of access to public equity markets and institutional credit facilities, the corporation faced a total liquidity collapse. On March 30, 2012, less than 10 months after the initial report's publication, Sino-Forest formally filed for corporate bankruptcy protection in Canada. This investigative model was applied to an enterprise of significantly greater scale on January 24, 2023, when Hindenburg Research published an investigative brief concerning one of India's largest infrastructure conglomerates. The report was titled Adani Group: How the World's Third Richest Man is Pulling the Largest Con in Corporate History. Prior to the publication, the conglomerate's founder, Gautam Adani, possessed a documented net worth exceeding $120 billion, ranking as the third wealthiest individual globally. The 7 primary publicly traded companies under the Adani Group umbrella had recorded an average share price appreciation of 819% over the preceding 3-year period, driven by capital-intensive expansions in Indian commercial ports, logistics networks, and green energy infrastructure. Hindenburg's analysis challenged the structural validity of these market valuations. The document alleged that the Adani Group engaged in systematic stock manipulation and accounting non-compliance over several decades, utilizing an array of offshore shell corporations registered in jurisdictions with low tax transparency, including Mauritius, the United Arab Emirates, and specific Caribbean islands. The report argued that these offshore shell entities, managed by relatives of the billionaire founder, were utilized to artificially inflate trading volumes and share prices of the conglomerate's listed subsidiaries, thereby manufacturing an illusion of high market liquidity and steady institutional demand. The analysis concluded that based on standard financial metrics, the market prices of the core listed shares were overvalued by an average of 85%, further stating that Adani Green Energy operated at a valuation premium reaching 815 times its actual price-to-earnings metric. The market impact, following the report's publication, resulted in a cumulative loss in market capitalization across the Adani Group's 7 core listed companies that exceeded $84 billion, eventually stabilizing at a contraction of over $100 billion during the period of maximum selling pressure. The publication date directly coincided with the conglomerate's attempt to execute a key $2.5 billion public equity offering. The rapid contraction in investor confidence and the sudden drop in secondary market share prices forced the Adani Group to completely cancel the capital raise, restricting its planned access to public infrastructure funding. To generate a financial return from this market decline, Hindenburg established a derivative structure designed to operate outside domestic Indian legal boundaries. Indian financial regulations imposed strict statutory limitations on foreign institutional funds regarding the direct short selling of equities listed on domestic Indian exchanges. To secure a short position while maintaining full compliance with local jurisdictional codes, Hindenburg shorted United States dollar-denominated bonds issued by Adani corporate entities and utilized global cross-border derivative instruments. When the valuation of the corporate debt instruments declined alongside the domestic stock prices, Hindenburg realized capital gains entirely outside the direct regulatory oversight of the Securities and Exchange Board of India. The economic consequences of these short-selling campaigns extend to secondary market participants. When Muddy Waters targeted Sino-Forest, individual retail retirement accounts and diversified public pension funds that relied on the structural compliance stamps of Western stock exchanges lost their capital reserves. The official corporate auditor for Sino-Forest was Ernst & Young, a major global accounting network. Ernst & Young had verified and signed off on the forestry firm's financial statements for multiple consecutive fiscal years, certifying the existence of the phantom timberlands. In the subsequent bankruptcy proceedings, affected shareholders initiated a class action lawsuit against the auditing firm, which concluded with Ernst & Young agreeing to a $117 million financial settlement to resolve allegations that they had failed to execute standard professional due diligence. Targeted corporations frequently engage in extensive counter-campaigns, leading to ongoing structural debates regarding the legitimacy of activist short-selling within modern financial ecosystems. Corporate executives regularly deploy corporate communication firms and legal counsel to allege that short-selling funds engage in a predatory practice defined as short and distort. In a formal corporate response, the Adani Group's communications department characterized the Hindenburg brief as a malicious, mischievous, and manipulative collection of selective data points engineered explicitly to generate predetermined outcomes for private financial gain. Targeted firms argue that these short funds do not contribute to capital formation or long-term infrastructure development, acting instead as financial actors that intentionally trigger programmatic market panic and margin calls to generate short-term profits at the expense of retail equity holders. Conversely, proponents of the strategy maintain that activist short sellers act as decentralized market monitors in a regulatory environment where state financial commissions face structural understaffing, limited resource allocation, and delayed intervention timelines. Because government oversight bodies are predominantly reactive, private short-selling funds operate with a significant direct financial incentive to identify and publicize corporate non-compliance before the scale of the discrepancy poses a broader risk to systemic liquidity. Proponents cite the regulatory outcome of the Sino-Forest case as evidence of this monitoring function. On July 13, 2017, the Ontario Securities Commission issued a final administrative ruling stating that Sino-Forest Corporation and its senior executive officers, including co-founder and former chief executive officer Alan Chan, had engaged in deliberate, systematic fraud and had intentionally misstated corporate assets to the public. The regulatory finding confirmed the core assertions of Muddy Waters' 2011 report, verifying that the multi-billion-dollar asset base was structurally non-existent. Nevertheless, even when the underlying data is validated by regulatory authorities, the legal and political opposition from multinational corporations and state-level regulatory networks can create long-term structural barriers for short-selling firms. The persistent litigation costs and institutional pushback associated with challenging large-scale conglomerates exert significant operational strain on independent research operations. Demonstrating these constraints, Nathan Anderson announced that Hindenburg Research was formally closing its short-selling operations. This decision altered the landscape of activist financial research, indicating that the legal and regulatory risks associated with challenging entrenched institutional networks have increased significantly. The execution of an activist short campaign underscores the high dependence of modern capital markets on institutional trust and data verification. The market valuation of a large enterprise depends fundamentally on the perceived accuracy of its verified reporting metrics. When an independent research firm presents primary evidence indicating that a corporation's reported assets are non-existent or manipulated, the electronic trading architecture responds with high velocity. The contraction of capital becomes irreversible as credit lines are restricted. Primary accounting firms withdraw their signatures to limit liability, and institutional asset managers liquidate their positions to manage portfolio risk. The structural framework developed by Hindenburg and Muddy Waters demonstrates a repeatable mechanism for liquidating corporate valuations from an external position. The broader consequence is a market environment where the structural stability of an international corporation can be directly challenged by a single, data-driven investigative report that forces institutional investors to reevaluate their exposure.